Secondly, European law requires all prospectuses to be vetted by the competent authority. In the UK, this is the UK Listing Authority. I mean, turnaround times are usually pretty quick, so 4 working days for the first draft of prospectus, 2 working days for subsequent drafts is the guideline that the UK likes to try and work to. But there's no doubt that the process extends the timetable for a main market listing. In contrast, an AIM admission document is effectively being supervised and vetted continuously by the nominated advisor, who has to report to the exchange at the end of the process that the AIM document complies with the AIM rules. What this does mean is there's no waiting time for comments, and there's no requirement then to sit down and process those comments and make sure that you've properly interpreted what the comments actually mean. As I mentioned, AIM companies must maintain a nomad at all times. Main market companies, which are directly accountable to the UKLA on an ongoing basis, only have to appoint an advisor, a sponsor, when they propose to issue a prospectus, or when they propose to issue what's called a Class 1 circular, a circular in connection with a major acquisition or disposal. So for main market companies, you haven't got that ongoing presence of an advisor on AIM. It's essential to have at all times. The minimum permitted market cap for a main market company is 700,000. I mean, that's really meaningless because, you know, if your market cap is less than 7 million or even 70 million and you're on the main market, there are going to be questions being asked. For what it's worth, AIM has got no minimum market cap requirement. As I say, that's not really a feature that one has to look at. The 700,000 figure is largely historical and probably due for some revision. In terms of the continuing obligations, let's just have a look at the compliance burden. So you've seen the difference in, if you like, weight burden between the two sets of rules. I'm not going to talk about the financial reporting requirements because Ernst & Young are here to address those quite specifically. In fact, I'm not really going to talk about a great deal of what's on this slide, but I think what I do want to emphasise is the distinction between AIM and main market in relation to information and shareholder approval requirements for transactions and follow-on issues. As I said, on the main market you're required to publish a prospectus not just for public offers, but whenever new shares are issued, which would increase the company's listed share capital by 10% or more. The main market also requires a detailed circular to be issued to shareholders for any acquisition or disposal where the target or company being sold represents 25% or more of the listed company in terms of market capitalisation, profits, turnover or assets, and also for transactions with related parties. And in each case you have to also get shareholder approval. In contrast, an issue of further shares on AIM will only ever require a prospectus if it's a public offer, and as I mentioned earlier, those are pretty rare on AIM. And a transaction will only require a circular and also shareholder approval where the target represents 100% or more of the listed company using the same tests as for the main market. I think this distinction is a very good example of how the regulation of AIM is tailored for growth companies. It enables AIM companies to be quicker on their feet in executing acquisitions and fundraisings. It also means that once you've paid for your initial listing, further fundraisings, follow-on issues, and also acquisitions are going to be a great deal cheaper than they would be on the main market and indeed on just about every other market that exists. So, you're thinking of coming to London to list on one of our markets, and if you're not now, I hope you will be by the end of this session. What should you be doing at this point in time? Well, I'll give you a lawyer's overview, and later Ernst & Young will talk about some of the financial and accounting considerations, and duo partners will talk in particular about some of the structuring issues. As you know, on AIM, the exchange assigns the vetting and compliance function to the nominated advisor. It's the nomad who must report to the exchange that the company is appropriate to be admitted to AIM. There's a separate set of rules for nomads which gives some guidance as to what means appropriate. those rules and common sense dictate that the nomad undertakes quite a lot of diligence on the company. So it will commission legal and accounting diligence, sometimes also commercial diligence. Sometimes actually commercial diligence is required. So for oil and gas companies, you need to have a competent person's report actually in the document. So I suppose from a legal perspective, the first question to ask is, can my company survive a legal audit? So just to give you a highlight of the sort of points that you should be thinking about to see if you can survive. The title to the assets should be clean. The contracts should be up to date and in writing. It's amazing how often you deal with a company and the key contracts are just maybe in a board minute or in a piece of paper that has not been signed, may not even have been dated. So that's a key feature for establishing that the sweat and toil of the company can be converted into cash and make it a saleable entity to investors.